How's it going, everybody? My name is Matthew Owens. Welcome to Creative 1031 Exchange Strategies. I am a California licensed CPA and a full-time investor, and I have Bill Exter on the line as well. He actually specializes in 1031 exchanges and is runs at a company that acts as an accommodator for 1031s. And so it's a great strategy to utilize. Today, we're going to just have a conversation and talk a little bit about some of the strategies that different investors can deploy when it comes to 1031 exchanges, and how it can help you to mitigate taxes and even never pay taxes in some cases. So as I mentioned, my name is Matthew Owens, a CPA at heart. I quit my CPA firm job about 10 years ago. We've flipped a little bit over 550 houses in the last 10 years. We flip about 5 to 10 houses a month. We invest in a lot of value-add multifamilies. We invest in promissory notes. We invest in syndications. And I act a lot like a financial advisor for clients, helping them with their individual financial situation and their goals, and trying to help them understand what different cash flow streams are available to them. So I act like an operator on one hat and a financial advisor on another hat, just helping people with their overall budgeting and their goals when it comes to real estate investments. So I'd like to introduce you guys to Bill. And Bill, could you give us a little bit of an overview about your experience and your background?
Sure. I got into 1031 exchanges back about 34 years ago.
Okay.
It was actually an accident. I was a controller of a bank, and the bank started an exchange company, and they threw it at me, and I had absolutely no idea what it was. So
nice.
That was 34 years ago, and we have done over 125,000 exchanges during that time frame, and we've done quite a bit of it. So our specialty is really helping, advising, and consulting with clients on how to structure them and keep them in compliance with codes and regs.
Okay. And so you, when a new investor comes to you and is interested in a 1031 exchange, what is their primary purpose? What are they trying to do when it comes to 1031s? And I know some of this I'm going to keep it pretty basic initially, and then we'll get into some of the detail afterwards, just because a lot of people don't necessarily even know what a 1031 exchange is.
Sure, absolutely. Well, in a lot of cases, somebody who maybe bought a single family house, or maybe even fell into it by accident, it became a rental property, and then maybe 5 years later, they're ready to trade up to a duplex or a fourplex, and they sit down with their accountant and they go, holy cow, when they find out what they're going to have to pay in taxes. And then they ask the question, well, how am I going to trade up if I have to pay that?
Okay.
So the 1031 allows you to sell the single family and trade up into your more valuable, more units, more cash flow without paying any taxes.
Okay. And so that would be like a deferral of taxes, right? So you're basically selling the old property and not touching the money, and then 100% of the gain gets rolled into the new property until you sell that property, in which case you may be able to do another 1031 exchange and never pay the tax?
Exactly. So it's all tax deferred. I mean, a lot of people call it tax-free exchanges, but it's really tax deferred exchanges. If you keep exchanging throughout your lifetime, and then when you pass on, you leave the property to your kids or grandkids or whomever, okay, and whoever inherits that property will inherit that at a step up in cost basis, which means capital gain tax goes away, depreciation recapture tax goes away. So we have a morbid sense of humor. We call it swap till you drop.
Nice. But it's basically a way to, pass on property to your heirs, never pay the tax, be able to benefit off of the equity continuously over and over again throughout your lifetime. And then when your kids inherit it, they get this step up in basis to the current value of that property. And then they don't have to pay the tax on it if they sell it, right?
Exactly. Absolutely. So it really keeps the money in your pocket, working for you, building your wealth instead of paying it to the state or the feds. Okay.
And this does not work with primary residences versus investment property, right? Because you're not really depreciating that investment, the primary residence.
Exactly. It has to be something held as a rental property. It could be vacant land you bought for capital appreciation, so investment purposes, or it could be anything that you use in a business.
Okay. So like even, equipment that you bought and maybe you have a gain on it or something you've depreciated over a period of time, and then you want to go buy a new piece of equipment for that business, you can go through and trade it for a new piece, even though, maybe you bought the piece of equipment for $100,000 and you write that depreciate that equipment off over like 7 years, something like that, and then it's fully depreciated. But maybe you can get 50 grand for it at the end of 7 years, but you don't want to pay the tax on that 50,000. You can roll it into the new piece of equipment that you buy.
Absolutely. And a lot of people don't realize it applies to non-real estate, or what we call personal property. So we've done exchanges on aircraft, shipping, trucking, machinery, equipment, franchises, whether it be a McDonald's or Burger King or Subway or a franchise like that for other franchises.
Okay.
We've done beer distribution rights, baseball franchise, baseball teams. We've done a lot of interesting exchanges over the years.
So as long as it's so, what are the rules with regard to the types of property that you can exchange for another property?
Yeah, good question. A lot of people get hung up on the term like kind, and they get a lot of articles out there on the internet, and people say, well, if you sell a condo, you have to buy a condo. That is completely wrong.
Okay.
So there's really two issues: qualified use, which I think we're going to talk about later. Like kind, literally in the real estate world, means you're selling real estate, you have to buy real estate. So any kind of real estate qualifies for 1031 exchange purposes. It's really a wide open, broad definition.
Land for a building would work. Real estate land for
Absolutely.
Okay, interesting. And so, like, you would probably have to. So talk a little bit about that usage aspect that you were just briefly mentioned.
In fact, there's a lot of misinformation out there about that. So
Okay.
qualified use means that you're holding it for rental, investment, or business use. So how do you define, rental, investment, or business use? And it all boils down to intent. That's really the critical key, is intent. So a lot of people out there say things like, well, you haven't held it for 12 months, you don't qualify. Well, that's not entirely true. So if you can prove that you had the intent to hold it for rental, investment, or business use, one day would qualify. Obviously, the shorter the hold period, the more difficult it is to prove your intent to hold. Mm-hmm. Now, if you're an investor who buys, rehabs, and sells, or what we call flips or rehabbers, then you're really buying with the intent to hold for sale, not hold for investment, so it wouldn't qualify. Builders, developers, contractors, they typically buy, build, and sell. So they're holding for sale as inventory in a business, and that doesn't qualify. Now, if they were to buy, build, and hold and rent it out, now it would. It's held for qualified use, as they say. Mm-hmm. Mm-hmm. So it boils down to intent. That's really the key.
Okay, so if you were to buy an investment property, for example, and then buy it, renovate it, put a tenant in place, have a lease in place, and then someone comes by 2 weeks later and says, I'm going to give you a ridiculous amount of money for your property, you could technically, as long as you can prove that intent, you could technically do a 1031 exchange and not pay the tax, as long as you can back yourself up, right?
Absolutely. And critical things are emails. I mean, nowadays there's no letters. It's all by email between your accountant, your broker, your qualified intermediary, what have you. And if you put in there that I'm going to sell this as soon as I get it fixed up, you've just shot yourself in the foot.
Right.
But if everything says, I'm going to buy this, Mr. Accountant, how do I depreciate this? What are the tax benefits? Things like that. Then you set the stage for your intent to hold for rental purposes.
Okay, and I see what you're saying, where if you're a constant flipper yourself, like myself, it'd be very difficult for me to say, yeah, that specific one, I was gonna hold it, and so therefore I'm gonna go flip it because I'm doing so many activities. It probably, it's got to look right to the IRS and pass the smell test, I would assume, in most.
Absolutely. And it's funny how they just don't believe you.
Yeah, shocker, the IRS, right? The most ethical people on the planet, So when we're talking about like kind property, so when we're talking about real estate for real estate, or machinery for machinery, or airplane for airplane, or something along those lines, what if we're getting into kind of a unique mix, like a real estate REIT, where it's really stock, but can you trade that for real estate?
Good question. Typically, real estate investment trusts or REITs are securities. So securities are not like kind of real estate. What you're really buying is, or let's assume you're selling a single family residential property, you're going to buy into a REIT. You're really selling real estate and then you're buying a security, so it doesn't qualify. Now, there are exceptions to that. So there's something called an UPREIT, UPREIT, so it stands for Umbrella Partnership REIT. That's a long story, but you can do a 1031 exchange effectively buy a fractional interest as a tenant in common in a very large property that the REIT is going to take down or has taken down.
Okay.
And then you hold it for 1 to 2 years, and then after that, it gets contributed into the REIT. So I've oversimplified that, but that's one of the exceptions. But in most cases, it wouldn't qualify because it's considered a security.
But you could do stock for stock, though, in something like that, or which is security for security.
Stocks, bonds, mutual funds, anything that's a security is actually specifically excluded from 1031 exchange treatment. So wouldn't qualify. Also, partnership interests. So if, in fact, a lot of your listeners probably have real estate in an LLC with multiple members.
Okay.
And they have to realize that they really don't own real estate, the entity does. So when the entity sells, and if they're going to distribute the cash, the individuals can't do an exchange unless they make some changes, because they're really just getting a cash distribution.
Okay. So what normally would need to happen then is the entity that's holding the property or the whatever asset it is the one that needs to do the 1031 exchange then in that case. Is that correct?
Absolutely. And if they're all staying together and nobody wants to break up, then it's a nice, easy transaction, and the LLC or the partnership does the exchange.
Okay.
If one or two want to get out, there's probably ways to buy them out. There's different ways to approach that. When they all want to split up, it can be really complicated. It depends on how much time we have to fix the situation.
I just ran into a client the other day that had a husband and wife that they were divorced at the time, and they came in with a real estate that they sold out of an entity, and he was able to set up an individual entity where his money flowed to that and own the new property inside of that entity somehow through the 1031 exchange accommodator, set it all up and did everything for them. I know that's definitely complex, and we'll touch on that if we have time, because that kind of stuff, real hairy, I can imagine, with that stuff. So, and so you talked about the specific exclusions. So you're saying stocks, partnerships, any kind of security, which would be a promissory note or something along those lines, I would assume, or technically securities. Anything else that you can think of that would be excluded from this?
For the most part, it's exactly what you just mentioned, and then anything used for personal use. So your primary residence, a second home, property used as vacation property. Now, that of course boils down to what's your intent. So you can always change your intent to stop using it for personal use, start renting it, and convert it to investment property. So there's a lot of ways to deal with that.
Okay, so there are ways to do that. I would assume there has to be some time requirements involved or something that needs to show what your true intent was, instead of just saying, yeah, it's not personal all of a sudden, and let's go do a 1031. There has to be some predetermined motive, I would assume, to change it into an investment property.
Absolutely. Yeah. And when I mentioned before that there's a lot of people who talk about the holding period, the holding period's not the end all. It's not what drives the decision, but it's part of what helps support the decision. So if you're trying to prove your intent was to hold for rental purposes and you've rented it for 24 months, which probably straddles 3 tax returns, it's easy to prove intent. Mm-hmm. If you held it for 30 days, then you've got to prove you really did have the intent, because 30 days is really hard to make that argument.
Right. And so like I've been taught as a CPA that most 1031 exchanges won't go through unless you've held it for 12 months and a day, which isn't always necessarily the case, as long as they can prove that intent and it's not available for sale right away. And the hold period is what really, or the hold intent is, and the backup to that intent is really what matters.
Exactly. Yep.
Okay. And then, so let's talk a little bit about the funding, because I think, I have a lot of clients coming to me asking about, well, I want to go do a 1031 exchange, and they've never heard of a 1031 exchange accommodator before, or what you guys do for them. And so can you talk about some of the funding rules and where the way the money has to flow in order to do a successful exchange, and what not to do also?
Yeah, absolutely. So probably the most common mistakes we see out there is an investor who thinks they only have to reinvest their profit or their taxable gain, or they only have to reinvest their equity, the net cash that comes out of the sale. And those are both not true. They really have to reinvest their net sale price, and we have to be careful in defining that. So just to keep it easy, you take whatever you sold the property for, your gross sale price, subtract your selling expenses. It's not all the closing costs on the settlement statement. It's just the selling expenses. So your broker's commission, yep, title, escrow, closing attorneys, documentary transfer tax, recording fees, things like that. So if you got $1 million sale price, your net sale price, you know, is probably about about $950,000 after you subtract the selling expenses. And that's the magic number. That's what you have to reinvest. So whatever you buy on the purchase side, whether it's one property or if you buy 2 or 3 or 4 properties, the total value of what you buy has to be $950 or greater. It's what we call trading equal or up in value.
Okay. Okay. And then, so if someone is in escrow about to sell their property, at what point do they come to you, and what happens with the proceeds on that sale? What needs to happen on that piece of it?
Oh, good question, because the 1031 exchange has to be set up prior to anything closing. So literally, we get calls every week where, you know, clients have sold their property, closed on the sale of the transaction. Maybe the next day or a week later, they talk to their accountant, and the guy says, "Well, you should have done an exchange." So they'll call up and say, "I want to do an exchange." At that point, it's too late.
Okay.
So the trigger is once the sale closes, they have the right to the funds, and that's what makes a taxable event.
Okay.
So the 1031 exchange has to be set up in place prior to closing, so the right to the funds actually comes to us as the qualified intermediary.
Okay.
And then we'll give the closing agent instructions on how to wire the funds to us, and we'll deposit it into their 1031 exchange account.
Okay, so basically you guys hold all funds. So no matter what happens, one of the biggest triggers is the right to the funds. Not even collecting the money in itself, even if the closing escrow company is still holding funds. If it's closed, that's when it triggers the tax, not when they
exactly.
And technically they can't obviously touch the money either in that case. Otherwise, it's a taxable event too. So okay, I've had a couple people come to me that, you know, they'll get $100,000 and they say, well, I sent it back to escrow because I didn't cash the check. But you know, it doesn't really help if they haven't done it yet. You know, if it's closed already.
That's exactly right.
Okay, that makes
now, sense. Partial exchanges are okay. So if somebody says I'm selling for $1 million, but I want to pull $100,000 cash out, they could certainly sell for the $1 million, buy for $900,000, and take the $100,000 difference. And that's still a permissible exchange, except they'll pay tax on the $100,000 and they'll defer everything else. So partial exchanges are okay.
Okay. So you can, depending on what the client's interested in doing, you can mess with the transaction to be able to hit what their goals are with regard to cash in their pocket, which they'll pay the tax on that piece of it, and then at the same time rolling over the rest into the exchange, so they're not having to pay the tax on it, which is really cool to be able to do that, because everybody's different, and some people might need some cash or to buy somebody out, like you mentioned, you know, or something along those lines. And so when a partial exchange like that happens, you know, normally my understanding is that when you actually do a normal 1031 exchange, you know, say you bought a property for $200,000 and just to keep the numbers simple, and over time you depreciated it to $150,000. And now you're going to go sell it for $250,000 and have a $100,000 gain that you want to defer. When you buy the new property, your basis in the new property carries forward from the old property, right? So how do you determine what the basis in the new property is? Is it the $150,000 previous basis plus whatever difference in purchase price on the new purchase?
Yeah, that's the easiest way to explain it. So in your example, if they sold for $250 and bought for $250, then the new cost basis in the new property would effectively be exactly the same as the old property, tweaked a little bit for closing costs.
Okay.
If they sold for $250, bought for $350, they've acquired another $100,000 of cost basis. So their cost basis would get moved over plus $100,000.
So their depreciation will be affected based on, on the new property, based on their current basis and whatever the difference between the purchase price is on the new property, as long as they hit their goals. Let's talk a little bit about that. You know, what are some of the requirements regarding to pull off a successful 1031 and not have to pay any tax, as far as cash infusion, purchase price, loan amount, those different things involved in the transaction? What are the rules there?
Sure. And the easy way to look at it is you have to trade equal or up in value. So whatever you buy, if it's one or multiple properties, the total purchase price should be equal to or greater than what you sold.
Okay.
All of your cash that comes out of your sale, your net equity or cash proceeds, have to be reinvested. So if you've met those two requirements, you're in good shape, because the difference will be the right amount of new debt, new financing on the property. Now, a lot of people out there on the internet will write an article and they'll say you have to replace your debt. And, you know, that's true for the most part, because most of us don't have cash laying around to put into the property. But in your example, when you sold for $250,000, you could go buy the next property, pay, you know, reinvest all your equity and put out-of-pocket cash in and buy it for $250 all cash. So you wouldn't have to reinvest or replace your debt if you wanted to put more cash in.
Okay, so if I went and sold a property for, you know, $250,000 and went and bought something for 300, and I had 100 grand in current cash from the 1031 exchange, you know, and if I bought it for 300, then I still have to bring 200 to the table in order to not come up with any additional debt. So the debt requirement is strictly if they don't have additional cash to put in. Then is what you're saying.
Exactly. And in today's market, you know, it's a hot market. It's moving fast, multiple offers, bidding wars, things like that. So we've got clients who'll come in to do the exchange and will put out-of-pocket cash in temporarily just so they can make an all-cash offer, and then wait 2 or 3 months and then do a cash-out refi to get their cash back.
Okay.
So it's a strategic issue to deal with the present market.
Can you talk a little bit about the kind of the rules and your understanding of the cash out refinance and what the kind of limitations are with regard to refinancing 3 months later versus immediately, and kind of your understanding of the rules there?
Sure. And there's really 2 parts to that. Do you refinance before you do the 1031 exchange? So in other words, do you refinance your relinquished property?
Okay.
Or do you refinance the replacement property after your entire exchange is completed?
Okay.
We do know the regulations has language in there that says, you know, refinancing in anticipation of an exchange is a problem. So refinancing before you start the exchange is not a good thing, unless you've got plenty of time between the refinance and the actual exchange. So, you know, I think if you got 6 months between the two or more, I think you're probably in good shape.
Okay.
It's probably safer to finish the exchange, close on all your replacement properties, wait a few months, and then start the cash out refinance process. There's actually a private letter ruling where the guy refinanced a week after he finished his exchange, but the ruling wasn't on point. The ruling wasn't talking about his refi, but it didn't also disqualify it. So we're pretty comfortable. A week might be okay, but, you know, why push the envelope?
Right. Right. Okay, that makes a lot of sense. So I see. And so you know, I have some clients right now that, you know, I've given seller financing to that are looking to try to refinance afterwards, because I help with a lot of the replacement property for these 1031 exchanges, which I think is probably one of the biggest challenges, especially in a market like right now when you're dealing with multiple offer situations and cash, and, you know, you need to get something. You have to identify properties within 45 days, right? On the initial.
Yeah, absolutely.
And so can you talk about the rules there between the identification period, the close period, and what people have to abide by?
Sure. And it's 45 calendar days from the close of the sale transaction. So not when you sign the contract or go into escrow or anything like that. So when you actually close, and let's say you close today, tomorrow would be day number 1, and you have exactly 45 days to identify what you're going to acquire. 45 days moves pretty darn quick. That's 6 weekends to go out there and look for properties.
Well, sometimes it can take 45 days just to close, but you don't have to close by then. You have to close afterwards, right? You just have to identify.
Exactly. So you got 45 days to identify, and then you have an additional 135 days for a total of 180 to actually close on your acquisitions.
Okay.
So that's really the key.
There we go. So when you're actually going through and working on these different exchanges with clients, what are the biggest challenges you're seeing them run across?
In today's market, the big one is the 45 days. With a regular exchange, you're selling, which triggers your capital gain, and then you have that 45-day identification period. That's one of the big ones. So they really need to start looking for property as soon as they know they're going to do an exchange. Don't wait till you're in the 45-day period. As soon as you know, start looking and getting it lined up. Working with somebody like you where you get property kind of in inventory, it makes it a lot easier too.
Right.
It takes a lot of the risk out of that. You can look at things like reverse exchanges where you can buy first, sell later. That takes some of the risk out of that. But reverses are more complicated, a little more challenging, so it's not for everybody. The other area that we look at a lot is how do you sell the property? How do you hold title on the sales side versus how you're going to acquire on the buy side? And you just see all sorts of things that are just common mistakes. They don't realize it doesn't qualify. We had a call today where he and his wife were selling as individuals, but they've got credit issues. So on the buy side, they decided to have their parents buy the replacement property, and then immediately after the next day, they'd buy it from them. Well, at the closing, the parents bought it. And at the sale, the husband and wife sold it. So they're two different taxpayers. So the exchange doesn't qualify. So part of our job is to review the documents and catch little errors like that are going to be a problem.
Yeah, I've seen the same problem where a lot of people will be having to do the exchange inside of an LLC, and then they think they're going to be able to go and get replacement property in their own name, but they can't get the financing because the 1031 has to be in the LLC, but then the financing has to be in their own name in order to qualify with traditional bank financing. And so they have issues like that come up. And so that's what I've done in that instance is I've went and given seller financing to those clients that can't get that traditional financing, and then tried to help them later on get the regular financing. But it's definitely complex. I can definitely see some major issues with that. And so when someone is identifying a specific property with you and they say they found their property and they're okay with the qualifications and all that stuff, what do they have to do to actually technically identify a property?
I think almost all the exchange companies out there will actually provide them with some kind of an identification form. Mm-hmm. So really it's a matter of filling out the form, signing it, and either faxing it back or emailing it back to the qualified intermediary. So it's fairly straightforward. The key is the identification rules, and most investors will use the 3 property rule. So it's just a matter of identifying 3 properties, probably with the intent to buy one, but the second and the third would be backup properties.
Okay, and then what? So I understand basically you can't technically identify over 3 properties. Is that correct, or are we can you identify 3 properties but with some limit, or over 3 properties but with a limitation?
You can. So the vast majority of investors are usually wanting to trade up in value. So the 3 property rule is what they'll use. If you have an investor that's let's say they're selling one larger asset and they want to buy a bunch of smaller assets, the 3 property rule probably isn't suitable. Mm-hmm. So they're most likely going to look at the 200% of fair market value rule. So back to your example where you sold for $250,000, the 200% rule would be twice that, so $500,000. Okay. You could identify as many properties as you want as long as the total value that you identify is not more than $500,000 in that case.
Got it.
So that's really designed for somebody who's going to diversify among smaller assets.
Okay, and that makes a lot of sense. I mean, in our realm, when I'm dealing with properties in Tennessee that are 150 to 200,000, dealing with investors in California that are selling stuff for 1.5 to $3 million, they're definitely trading into a diversified pool of assets. Which, I've run into this exact 200% rule issue in the past, where it becomes really kind of stressful because they have to, abide by every little piece of the rule involved. So
absolutely.
Okay. And when they're trying to find these replacement properties, I can imagine they identify 3 of them, and there's not really, they could fall out. All 3 of them may not work out. And so what happens if, say, they identify 3 properties and before the 45-day rule ends, say they identify in day 15 and they got 30 more days left, can they take away that identification of the previous 3 properties and add 3 different ones instead?
Yeah, if they're still inside the 45-day window, then they can revoke their identification and then re-identify other properties. Once they pass the 45 days, then they're stuck and they have to acquire something on that list.
Okay. So I can see where people would buy bad deals sometimes just to get their deal done, in those types of situations without doing their homework. I had a client recently that, they were looking at a bunch of properties in California. They were performing at like three caps, which, you buy all cash. For those in the audience that don't understand, they buy all cash. They're making 3% on their money, which is really, really low and doesn't cash flow very well. And so, that was the only thing they knew until they met me and I started helping them with higher cash flow assets. Where even at leverage, they're making 10% plus on their money, and now, that client specifically is going to be able to retire off of the cash flow now versus making, half or a quarter of that in a California asset that is not going to give them that. And in a market in California where we've had a major uptick and, they're buying at the worst time possible in California, in my eyes at least, when it comes to, appreciation. My opinion, the best time to buy in California is when you can get that uptick in appreciation because it's so volatile. It goes up and down so much. Sometimes it's very beneficial to do that if you have the right strategy involved or investing at the right time. But, otherwise, I personally invest in cash flow first and that appreciation second, just because I want the income. I want to live off of it and create the life I want, So,
Absolutely.
but so can you talking about some of the different rules involved, and say they passed the 45-day window, they got their three properties, and they're getting close to closing on one of these things. At what point, how long do they have to actually close escrow? And after the 45 days, what are some of the issues that do come up? I can imagine due diligence and things like that are in that process, and you have some major issues that come up. What are the things you see most common that cause headaches for investors?
Certainly, the due diligence issues uncovers all sorts of challenges, defects with the property, and all sorts of the usual things you'll find. The other issue from a 1031 exchange perspective is you have to be careful when you disclose that you're doing a 1031 exchange because the seller of the replacement property can use that against you. So if he or she knows that you've identified the property, you're past your 45 days, and you really have to buy their property, they've got you. Okay. And so you have to be careful when you disclose that. And then, the best case scenario is do your due diligence as soon as you can. Try to do it in the 45 days. Try to get it under contract. Try to get it as close to closing as possible. I know that's not always feasible, but try to do it. The closer you get to closing or closing during the 45 days, the less risk you have.
Okay, that makes a lot of sense. Yeah, I've seen a lot of issues where all of a sudden during due diligence, a couple of the properties make no sense whatsoever, and then the other ones are gone already. The other two that they're working on because they wanted to close on one specifically, and then it just doesn't make sense at that point. Like they're now they're buying a bad deal to save on taxes, and it's like which one is better? So that's a major issue that I think a lot of investors face. And probably one of the biggest challenges is finding that replacement property, especially in a hot market, and then doing the homework and knowing what to do on the homework too. So I think a good realtor or someone that can kind of help them with the due diligence up front and quickly is probably one of the most important team members when trying to do a 1031. And so, obviously, the qualified intermediary, which is what you help people with, is this probably the most important team member to tell someone, here's how your numbers break down so you can hit your requirements. How fast are you able to get back to people with regard to those numbers so that before their 45 days is kind of clocking?
Usually we can discuss it just over the phone with them because we can just talk in very general terms. We can talk, kind of the 30,000 foot level. And then when they want to get nitty gritty down to the details, that's when they really need to go to their accountant to make sure they've got exactly what numbers they're looking at.
Okay. And then on the accommodator side, or the intermediary side, what are some of the pros and cons or strengths and weaknesses of different intermediaries that exist? Have you seen problems with some? What are the things you see with with intermediaries that have what problems do you see on that side?
Sure, and it's part of that due diligence process too, in which they should hopefully do before they sell any of their properties. I mean, go through that whole due diligence, pick the qualified intermediary, pick your realtor, pick your accountant, have your team lined up. I can tell you that usually doesn't happen, but it's really better to have it up front in advance. With a qualified intermediary, we've seen a lot of issues. I've been doing this for 34 years, and People focus on things like fidelity bond and errors and omissions, and those are important. You want that insurance in place. The fidelity bond is crime insurance, so you're covered for theft of funds. The E&O is, for errors and omissions. It covers you if we screw up. But the biggest area that I've seen losses in is where the qualified intermediary doesn't review the transaction documents, doesn't catch problems. They kind of go through, and once it closes, it's almost impossible to correct things. But before closing, a lot of things can be corrected. So it's really the right person who's willing to review the documents and then point out the issues and say, your accountant needs to look at this, your attorney needs to look at that, etc., before closing. So it's really somebody who's got the experience, the expertise in all the pieces of that team together.
Okay, and that makes a lot of sense. What about fee structures and things like that? What do you see out there? What's the norm? What makes you think someone's getting ripped off?
Good. In fact, that's a really good question. We had a client conversation today where they found a qualified intermediary on the internet for, I think, $395, and it's like, well,
they got to be doing nothing.
Get what you pay for. Yeah, be very careful. That kind of thing. I would say on the West Coast, you're going to see fees that are probably in the $700 to maybe $1,200 range. And then when you get to more toward the East Coast, they might get as high as $1,800 or $2,000 because there's less competition.
Okay.
If you're working with a really qualified intermediary, a lot of experience, a lot of expertise, et cetera, for a forward exchange, they're probably in the $700 to $900 range for the most part. If you get one-offs, sole mom and pops, attorneys or CPAs who are just doing the qualified intermediary business, they tend to charge a little more. But that gives you an idea. If it's way under $700, be very careful. If it's way over $1,200, you're being overcharged, unless you're looking at reverse exchanges or more complex exchanges.
Stuff. Right, like some legal work associated with it or something like that could be thrown in. Okay, that makes a lot of sense. And when you're dealing with, I think you made a very good point with regard to the bonds and the backup for holding the assets. I know a lot of attorneys that have gotten in trouble for commingling funds or messing up their accounting, and then all of a sudden they don't have what they should have had in their accounts. And I think that piece of it, to have insurance in place for that, can be huge. I know people that have lost money because they wired money to an attorney supposedly in their trust account, and then it's gone. Or they messed up and they dispersed the funds to somebody else by accident or something crazy. So to have that kind of insurance, I think, is really important, to have that trust account set up and things like that. And in my opinion, there's no reason ever to not do a background check and a criminal check on a company or people, or ask around and ask for references. I think those types of things, whenever you're doing business with anybody, are the most important thing you can do. I just stopped somebody from investing in a syndication recently that they had I made them do a background check. They did the background check. There was a $50,000 tax lien on their house. There was some criminal charges from 20, 30 years ago. It shows their personality. It shows what is actually happening. Now, don't get me wrong. If they disclose it up front to you or something and tell you, then great. But those are the things. Those second checks are what really keep you out of business. Because don't get me wrong, I've been totally screwed over a million times from people that I thought I could trust fully, and then they don't take me. And I feel like I'm a really good read of people, but sometimes they just got, I don't know what another word for it, but they have game. They can talk a great game, and I'm sitting there going, great. I thought I knew that guy. He just took me for $50,000. Great, So those types of things, those extra homework assignments, I think will help substantially.
And there's a complete scam that's going on right now in the real estate world. And they originally started targeting title companies, escrow companies. Then they kind of moved on. They started targeting exchange companies, and now they're really targeting the investors themselves. But it all revolves around some type of a real estate transaction. And what happens is somebody, escrow company, title company, qualified intermediary, will email wire transfer instructions to the other party. And then somewhere after that, their system gets hacked, and somebody sends them another email saying, here's updated wire transfer instructions. Well, they're fraudulent. And if you're not careful, you will get burned. And I've seen escrow companies go out of business the last year or two because they ran out of money. They lost it. So anytime you get an email that says these are revised instructions, stop everything, call the escrow company verbally over the phone, verify the wire transfer instructions, and make sure they're accurate.
Our closing attorneys won't even send wire instructions via email anymore. It's a secured email server that they send it over because of this issue, and it's very, very common. Someone a while back stole my email, and they started sending emails to people that looked like my name, but it was a different email address. And so these types of actually happen consistently, and I think it's a matter of when, not if, it's going to happen to you, especially with technology now. I think there was a big hack recently where, a lot of people with LinkedIn and Dropbox and a lot of these different services were hacked. And so everybody on that list has to go change their email address and things like that. And so, with any real estate transaction, I think this is a risk with hacking. I think that type of thing is really important. So
absolutely.
And so I'm gonna reframe the conversation a little bit back to 1031 exchanges, and I'm gonna bring up a topic that's a little confusing, I think, for probably 90% of the people that do exchanges. Can you talk about what boot is and how that works in exchange? Because I've done a few 1031 exchange tax returns, back in the day, and I can tell you it was one of the most complex transactions when there was boot involved that I could ever deal with.
Absolutely. And essentially the easiest way to describe it is, let's just say somebody sells property for $250,000 and they reinvest at $200,000. So they sold at $250,000, bought at $200,000, they've traded down by $50,000. That $50,000 is taxable. We call it taxable boot. If you receive it in cash, it's cash boot. If you trade it down in value, you reinvested all your cash, which means you just got less debt, it's mortgage boot. So that's the easiest way to look at it. I'm not sure where the term boot came from. I heard someone say that it was a French term, but I'm not sure. But it just means it's taxable, basically.
CPAs made it up to confuse people, so that way they can get paid more money. It's boot. Nobody knows what the heck.
That's right.
Random. So it's just additional cash that you would get, just like what you were talking about earlier, where someone wants an extra $100,000 out of the transaction. That would be considered boot, I would assume, right?
Absolutely, yep. And the other thing just to keep in mind for those listening is when you go to sell or you go to buy real estate, your closing statement has all sorts of items on that. And they really fall into three buckets. You've got selling expenses or buying expenses. You've got lender-related charges, fees, and costs. And you've got operating expenses, prorated rents, prorated property taxes, HOA fees, things like that. From an exchange perspective, only the selling costs are permissible. If you use exchange funds to pay for lender fees or any operating items, you can do that, but it's taxable boot. So even though you're not pulling the cash out, you're using some of the exchange funds to pay for non-permissible expenses. So usually only a couple $1,000s, but it could be taxable boot.
Can you go over it one more time? What are the specific, based on what you normally see on a closing statement with lenders and closing costs, what are the specific non-exchangeable fees involved?
So from the lender's perspective, if it's on the sell side, it's probably any small fees to cover the loan payoff. So demand statement fees, things like that. So there's not a whole lot there. On the buy side, you may have fees, points, doc fees, prep fees, things like that. Those are all lender-related items. If there's an appraisal that is lender required, that's a lender item. So none of those should be paid for with exchange funds. It doesn't hurt the exchange if you do, but you're going to have a small taxable event. And then any of the operating items, the property taxes, the insurance, the prorated rents, the HOAs, same thing. If you pay that to them or you use your exchange funds to pay for that, it'll be taxable. If you got multifamily, you're probably holding a sizable chunk of security deposits. If you use exchange funds to pay that to the buyer of your property, that's going to be a taxable event because it's really a liability, a personal liability that you're using exchange funds to cover.
Okay. So in those types of cases, what are the actual expenses that you can include in an exchange?
So the permissible would be any selling expense. And of course, typical selling expenses vary from region to region, but there'll be things like your broker's commission, Title insurance fees, as long as it's the owner's policy, not the lender's policy. A lender's policy would be a lender fee. Any escrow closing fees or attorney closing fees, recording fees, documentary transfer taxes, things like that, exchange fees would all be permissible.
Okay, and I'm surprised the lender fees are not included in that, because in my eyes that's like part of the actual transaction to get the deal done, is getting
Yep.
the loan in place to actually buy the new asset. So you're saying basically if you don't come out of pocket for those items and use exchange funds, then that portion, if it's $5,000 of lender fees or whatever it is, that portion will still be taxable, like boot basically in that case, where
Yes,
like you getting cash for those items. Then in that,
absolutely.
okay.
That's exactly right. They really kind of break it out between purchase costs and financing costs. So any financing costs wouldn't qualify.
Okay, that's a great information, because a lot of people don't have I didn't have a full understanding of that. That's absolutely great. And so, we talked a lot about the risks of replacing property and, the need in some cases to do a reverse exchange. Can you kind of explain the process involved in a reverse exchange and how that works and what the requirements are?
Sure. First of all, they're both fall under Section 1031, so they're both 1031 exchanges. They call this one a reverse because you're buying first, you close on your purchase, and then you have 45 days to identify what you're going to sell. So in this case, you probably know what you're going to sell. It's just a formality.
Right.
And then you have a total of 180 days to actually close on the sale of your property that you identified.
Okay.
So it's really effective in markets we have like today, because you're out there with multiple offers, bidding wars, and if you sell first, doing a regular exchange, you've triggered your gain.
Okay.
If you can't identify property and it's a failed exchange, it's taxable. With a reverse exchange, you take all the time you want. You go out and you find the suitable replacement property, go under contract, go into escrow. You can actually close on it, so you've got that, and you've eliminated the risk about what if I can't find it. Worst case, you can't sell your existing property, which would be unlikely in today's market. But if you couldn't sell it, then your reverse exchange fails, but you haven't sold anything, so there's no tax consequence.
Okay.
So that's really that's the benefit. Now, they're more complicated, more expensive, because we as the qualified intermediary have to acquire and hold title to one of the two properties. So it's what the IRS calls a parking arrangement.
Okay.
And that's where it gets more complicated. If there's lenders involved, it's going to be even more complicated. Lenders aren't thrilled with us holding title when you're the borrower. So
Right.
a little more challenging with that.
So in a reverse exchange, someone can get a loan initially, but the lenders are going to be real picky about it. It's going to have to be the right lender. If not, they're probably buying with cash, but then the intermediary is holding title to the property, or and then once they find the new property to replace it with, then they sell that and they use those proceeds to kind of replenish their cash or their down payment on that side?
Absolutely. Yep. That's exactly right. And so really up front, it's just a parking arrangement, assuming we're taking title to the replacement property.
Right.
And at the back end, it's really a simultaneous exchange. So you swap everything at the back end.
Okay, so it's almost like you're having to pay closing costs for the initial piece into the name of the intermediary, and then another set of closing costs when you change title on the back end. And so that's where you're saying it's a little bit more complex then in that case. And
exactly. And there's we have to hold title to the property. We're going to triple net lease it to the client. So the client will have the ability to rent it, collect the rents, pay the bills, things like that. So that gets a little more complicated. And there's other things that may come into play, just depending on the situation.
Okay. And so in order to do that, if you can't find a lender that will do that, then you pretty much have to buy the replacement property with cash if you have it in order to make that happen.
Exactly.
The lenders, I can only imagine, unless they're a commercial lender and fully understand the transaction, then I can imagine that 90% of them are going to say, I don't want to deal with it. They're not going to live.
That's right. That's exactly right.
Okay.
Hard money guys love it. Private money guys will love it. Portfolio lenders will take a look at it. If they're conduit lenders, like typical mortgage operations, they're not going to touch it.
So in that case, you would use a private money or hard money lender to close that transaction, you would give them full rights to buy, the person that's doing the exchange, full rights to run the property, do everything, pay the mortgage, all that stuff. I would assume the buyer or the 1031 exchange investor is actually still obligated on the loan, I would assume, in some way, versus your company being obligated on the loan. I wouldn't think that that would be, if I was in your shoes, I probably wouldn't take the liability on it. So, some random, 10%, 15% hard money loan. So,
Yep.
and then after you do the exchange on the back end, then they typically would wait, call it, 6 months, and then refinance it with a traditional lender or something like that? Or is that kind of
Yep.
the idea behind it?
Now, even at that point, if you're doing a refi without cashing out, you can probably refi at any point in time. It's when
Okay.
they're cashing out that you probably want to wait a period of time.
That makes sense when they're getting cash back in their pocket, because that would be considered more boot and cash back in your pocket that could be considered taxable. Is there
Exactly.
case law on the amount of time? Do you know, or I know you mentioned one piece of law that or one recommendation that came out on the amount of time that takes before they can pull money out.
There's not much out there. It's
Okay.
just it all boils down to intent. So as long as you can show your intent was to stay invested, I think you're good to go. So a refinance is absolutely okay, but refinance cash out would be the risk.
Got it.
Although if you're refinancing cashing out and then you're reinvesting in that property, doing repairs, maintenance improvements, whatever, you're probably safer.
Mhm.
For me personally, I'd wait 2 to 3 months before I even start a cash out refinance. And if you don't have to, wait even longer. The longer the better.
Yeah, just to be on the safe side so that you don't get bit from, and if it's in 2 taxable years, it's probably even better, I would assume. So, okay. And then, so one other quirk here. So I can imagine that when some people that are doing 1031 exchanges have a big gain built into their sale, which is the reason why they're doing it in the first place, and they might want to go do a seller finance transaction to a new buyer
Mm.
when they're selling. And that means they're not really getting much, if any, cash in some cases. I can imagine that, sometimes they might make them put a down payment down, or most cases they might put a down payment down, but it may not be a lot of money to then go buy a replacement property. Have you seen this in the past, and how have they structured and made that transaction happen?
There's a number of ways of doing that depending on what their goals are. The one thing they have to remember is that the sale is occurring up front. So they're choosing to sell the property and they're choosing to do a seller carryback note, but the sale has occurred. So the fact that they're going to get a balloon payment, let's say 2, 3, 4, 5 years down the road, that's not exchangeable because that's just a payoff of a loan. The
Okay.
sale has really occurred up front. So if they want to defer all their taxes, then they're going to have to set up an exchange for the entire process, the entire exchange, a sale.
Mhm.
And including in that, we would get the cash and they would draft the promissory note in our name as the qualified intermediary. So that way in the exchange account, we're holding the note and cash. Now that's the easy part. The tough part is what do you do with the note? So somehow we have to convert that note to cash so you could use the note toward the purchase of replacement property. If you find a seller who's willing to take an assignment of the note, that would work.
Uh-huh.
You could sell the note to any investors. There's a lot of people out there who'll buy notes, but usually you buy it at a discount. Or if the taxpayer has enough cash, the taxpayer can actually be the bank and loan the money, essentially buy the note out of their own exchange, and that would also work.
So you pretty much
Um,
have to get it. You have to get the note in cash in order to actually successfully do the exchange. If you don't have your own cash sitting there to do your cash requirements. So the in a seller finance 1031 exchange, you have to replace your purchase price, equal or greater than purchase price, and your cash plus the note balance that you've seller financed in order to actually successfully do that exchange. Otherwise, the seller finance note is considered a boot or cash in your pocket. Is that right?
Absolutely, because that's part of the payment. You're getting cash and you're getting a note, and that's part of what the consideration was. In some cases, it just doesn't work, and the cash is going to be reinvested, may or may not defer taxes, depends on how much you end up buying. And the note may end up back with the taxpayer, and in that case, it's taxable under Section 453 as an installment sale note.
Okay, good. So you can use an installment sale and do a 1031 for part of it. Then, in that case, so that's huge to be able to do that, because to not have to do the installment sale piece, and you might sell or finance 75% of your sale price, and then you got
Right.
bonus, So in that,
Exactly.
so interesting. Okay, and so in kind of summary, I'd love to be able to have you kind of give an overall summary of, say, I'm new to 1031 exchanges, and I want to protect myself, and I want to do it right. Can you kind of go over just? I know we went over a ton of questions. You're probably going to repeat yourself just a little bit, but start to finish, what would I do if I am just about to enter escrow on my property? What would be the process, step by step, that I would go through first if I'm saying, hey, Bill, I'm about to do this 1031 exchange. What do I do next?
Hopefully, if I've done my homework and my business plan right, I've already got my team lined up. That probably doesn't happen. Usually doesn't happen, but
Okay.
that would be my first suggestion, to get a team together. In most cases, that probably doesn't exist. So before you actually execute the contract and sell the property, I would always run it past your accountant. Make sure you know what your tax implications are. In some cases, you may have a very small gain after closing costs. It may not be worth doing an exchange.
Mm-hmm.
You may have a loss on the property. And if you do an exchange, you have to defer whatever the consequence was. So if you structure an exchange and it turns out there's a loss, you have to defer the loss. There may be reasons you would want to do that strategically, but in most cases you wouldn't. So look at that. Know what your tax consequences are before you proceed. Otherwise, you end up with surprises. Then from there, you want a good qualified intermediary who can review the documents, walk you through the process, and make sure you don't have any snags that could disqualify your exchange.
Okay.
I would also have an attorney review it, and it should be an attorney who really knows real estate. There's a lot of attorneys out there who are generalists, but if they don't really understand real estate, then they're not really doing you a service.
I understand.
Same for the accountant. Get an accountant who really knows real estate.
Right. And I think it's important to find an accountant in the state you're doing business in as well, because in a lot of those certain CPAs, I mean, I don't pretend to know the state laws, in Arizona or Wyoming or, places I don't live or practice. So, and,
Yep.
And it's funny because I don't charge for tax planning services and things like that. And it's funny how most investors don't like doing tax planning. They think it's a waste of money or something, but in reality, they go spend $3,000 a year on quarterly tax planning or something, and they're going to save themselves 10 to 15 grand easily, on their taxes.
Absolutely.
By sitting down with a CPA. And most people don't understand the return on investment analysis associated with that. So I would absolutely recommend the same thing, and the real estate attorney too. There's so many different variations of real estate attorneys too. There's syndication attorneys, contract law attorneys, eviction attorneys, having someone who does, transaction law or contract law and things like that, reviewing the whole transaction, I think would be, probably one of the most important things. And getting a referral from other people in the business that are doing it, I think would be very, very key too. So when you say team, I think of the same thing: CPAs, attorneys, realtors, inspectors for your replacement property, property managers for replacement property, the normal, team members, appraisers, all of the different team members that go into that, including your contractors and everything else. So, from that standpoint, I think it's really, really valuable. The information that you're sharing here tonight, I think is something that most people don't know, and it'll stop people from making a giant mistake by not coming to you first before the actual transaction closes, or before 2 days before closing. Don't be coming to you to try to, I mean, it's better than after, but 2 days before closing, try to plan ahead at least a month if you can. So for everybody who's listening, because that's huge. So and Bill, can you give us your contact information and your website and stuff, so everybody knows where to reach you as an intermediary that can help people with this stuff?
Sure. Our website is exeter1031.com. So that's EXETER1031.com. And all of our branches and contact information is listed. Just click on Contact Us. My phone number would be 619-239-3091. So 619-239-3091.
Perfect. Thanks a lot, Bill. I really appreciate it. My information, if anybody's interested in replacement property or learning more about the investment side of things, is OCGproperties.com is my website. My phone number is 424-757-4680. You can email us at invest@ocgproperties.com. We'll have plenty of events like this coming up in the near future. This will also be recorded for everybody if they're interested in watching the whole thing later on. Thank you guys very much for your time. You can feel free to email us with any questions, or email Bill with any questions, or go to his website, and we'll relay the information if we get any questions for him as well. So thanks a lot, Bill. Really appreciate it tonight. Go have fun with the
My pleasure.
eat some dinner and relax. So thanks a lot.
Thank you.